You worked for it. For 40 years, maybe more, a piece of every paycheck was taken out for Social Security. You earned that benefit, and now, in retirement, you finally start collecting it. Then, tax season comes, and you discover something that stops you cold. The government can tax that benefit all over again. Up to 85% of your Social Security check can be counted as taxable income. Let me say that again, because most people simply do not believe it the first time. Up to 85% of the Social Security you already paid for taxed a second time. It is not a scam, and it is not a mistake. It is the law working exactly as written. And every single year, it quietly reaches deeper into the pockets of ordinary, careful retirees who never saw it coming. I am Henry Cole. In the next few minutes, I will show you exactly how Social Security gets taxed, the hidden trap that can push your real tax rate far higher than you think, the everyday money moves that trigger it, the truth about those headlines promising no tax on Social Security, and the simple legal ways to pay less. One quick note before we begin. This is general information, not financial or tax advice, so always check your own numbers with a professional you trust. Now, let us pull back the curtain on one of the most misunderstood taxes in all of retirement. Let us start with the big question. Is your Social Security taxed or not? And the honest answer is, it depends on one number. The government does not look at your Social Security alone. It looks at what it calls your combined income. Some people call it provisional income. Do not let the fancy names scare you, because the idea is simple. You take your regular taxable income, add in any tax-free interest you earned, and then add half of your yearly Social Security benefit. Put those three together, and that single number decides how much of your Social Security becomes taxable. And there are three levels. If your combined income is low enough, wonderful. None of your Social Security is taxed. Zero. But once you climb past the first line, up to half of your benefit can be taxed. And once you climb past a second higher line, up to 85% of your benefit can be pulled into your taxable income. Now, here is the part people get wrong, and it matters. Being in the 85% zone does not mean you lose 85% of your check. It means up to 85% of your benefit gets added to your taxable income, and then it is taxed at your normal rate. So the real question becomes, where are those lines drawn? And that is where this story turns from annoying into something genuinely unfair. Here are the actual lines. If you are single, the first line sits at $25,000 of combined income, and the second at $34,000. For a married couple filing together, the first line is $32,000, and the second is $44,000. Stay under the first, and your Social Security is tax-free. Cross the second. And up to 85% of it is on the table. Now look closely at those numbers, because here is the quiet cruelty. $25,000, $34,000. Those figures were written into law back in 1983 and 1993, and they have never, not once, been adjusted for inflation. Think about that. Nearly every other number in the tax code creeps up a little each year to keep pace with the cost of living. Your standard deduction rises, the tax brackets shift, but these Social Security lines have been frozen in place for decades. So a threshold that, back then, was meant to tax only the genuinely wealthy now reaches an ordinary retiree with a modest pension and a small savings account. Every year, as benefits get their cost of living raise, as pensions pay out, as required withdrawals grow, more and more middle-class retirees drift over those frozen lines. It was sold as a tax on the rich. Today, it is a tax on almost everyone. And that slow, silent creep is exactly why it blindsides people. But the frozen lines are only half of it. The other half is a trap so sneaky it has earned its own name. This is the part that catches even careful retirees completely off guard. So stay with me, because understanding this one idea can save you thousands of dollars. Financial planners call it the tax torpedo. Here is how it works. Imagine you are sitting in that middle zone, where crossing the lines is in play. You decide to pull one extra $1,000 out of your traditional retirement account. A perfectly normal move. You would expect to pay tax on that $1,000, and that is it. But that is not what happens, because that extra $1,000 of income does not just get taxed on its own. It also drags more of your Social Security across the line and into your taxable income along with it. So that single $1,000 withdrawal can make another $500 or even $850 of your Social Security suddenly taxable too. You get taxed on the withdrawal and taxed on the Social Security it pulled in behind it. And when you add it all up, the real tax rate on that one withdrawal is not the 15 or 22% you expected. It can quietly balloon to 40 or even 50% or more. That is the torpedo. A stretch of income where each extra dollar is punished far harder than your tax bracket would ever suggest. Most retirees never even know they are sailing straight through it. They just see a tax bill that feels far too big, and they cannot understand why. Now you understand why. But ideas are one thing, and real dollars are another. So let me show you exactly what this looks like on a real tax return. Let me make this real, because numbers land harder than ideas. Picture a retired couple. We will call them Bill and Carol. They are both on Social Security, and between their benefits and a small pension, their combined income sits right in that danger zone, just past the line where their Social Security starts getting taxed. Now, one ordinary afternoon, Bill decides to pull an extra $1,000 out of his traditional IRA, just a little extra to cover a home repair. Here's what Bill expects. He is in the 12% tax bracket, so he figures that $1,000 will cost him about $120 in tax. Fair enough, he thinks, but that is not what happens. Because they are sitting right in the torpedo zone, that $1,000 withdrawal does not just add itself to their taxable income. It reaches over and drags $850 of their Social Security into being taxable, right alongside it. So instead of $1,000 of new taxable income, Bill and Carol now have $1,850. Bill expected to be taxed on $1,000. He is actually being taxed on nearly twice that. And when you run the real math, the tax on his little $1,000 withdrawal is not $120. It is closer to $220. That is a real tax rate of about 22% on money he was sure would be taxed at 12. Now, in the higher brackets, this very same trick can push the real rate to 40 or 50% or more. That, in plain dollars and cents, is the tax torpedo. A stretch of income where the government quietly charges you far more than the bracket on paper says. And almost nobody sees it because it hides deep inside a tax return that is simply too complicated to read. So now that you can see it clearly, let us look at exactly what sets it off. The frustrating truth is that the things which push your combined income up and fire the torpedo are almost never reckless. They are the normal, responsible, everyday moves that good retirees make. Let us walk through the big ones. The first is withdrawals from your traditional retirement accounts. Every dollar you pull from a traditional 401k or a traditional IRA counts as income. The second is required minimum distributions, the withdrawals the government forces you to take once you reach 73, whether you need the money or not. Those are often large, and they land right in the middle of this zone. The third is Roth conversions. Moving money from a traditional account into a Roth is often a brilliant long-term move, but in the year you do it, that converted amount counts as income, and it can fire the torpedo. The fourth is capital gains, from selling a stock, a fund, or a property that has grown over the years. And here is the one that surprises everyone. Even tax-free municipal bond interest, the kind you thought was completely safe from taxes, still counts toward your combined income for this calculation. So the income you were told was tax-free can quietly help push your Social Security into being taxed. Do you see the pattern? Not one of these is a mistake. They are the ordinary rhythm of retirement. And that is exactly what makes this so easy to trip. But before we get to the fixes, we have to clear up the biggest piece of confusion out there right now. You have almost certainly seen the headlines. No more tax on Social Security. Seniors finally free of the tax. And I have to be honest with you here, because this is exactly the kind of thing that gives people false comfort and costs them money. Here is what actually happened. A tax law passed in 2025 created a new, temporary deduction for older Americans. If you are 65 or older, you may be able to claim an extra deduction of up to $6,000 per person on top of your normal deductions. For a married couple where both are 65, that can be as much as $12,000. But read the fine print, because it matters. This deduction is temporary. As the law stands now, it applies only to the years 2025 through 2028. It also phases out as your income rises, so higher earners get little or none of it. And most importantly, it did not repeal the tax on Social Security. Not at all. What it does is lower your overall taxable income. And because your income is lower, many middle-income retirees will now owe less, and some will owe nothing on their benefits, at least for these few years. That is genuinely helpful. And if you qualify, take it. But do not confuse a temporary deduction with the tax being gone. The underlying rules are still on the books. Those frozen lines are still there. And the torpedo still fires, which is exactly why you still need a plan. So let us build one. Here is the good news, and it is real. You are not helpless in front of this. With a little foresight, you can steer around the torpedo, and in some years, avoid it completely. Let me give you the core moves. The first, and the most powerful, is the Roth account. This is the big one, so hear me clearly. When you take money out of a Roth, it does not count toward your combined income. It is tax-free, and it does not drag your Social Security into being taxed. So a retiree who has built up money in a Roth has a source of spending that flies completely under the radar. The second move flows from the first. Roth conversions, done in the right years. There is often a quiet window between the day you retire and the day required withdrawals begin at 73, when your income is low. In those years, converting a portion of your traditional savings into a Roth, a little at a time, can shrink the forced withdrawals later and defuse the torpedo before it ever fires. The third is simply managing your timing. Instead of taking one enormous withdrawal in a single year, you can often spread it out, keeping yourself under those lines. The fourth is a beautiful tool called the qualified charitable distribution. If you give to charity anyway, you can send money straight from your IRA to the charity. It satisfies your required withdrawal, but it never counts as income to you. And finally, remember that capital gains and even that municipal bond interest count too. So plan your sales and your investments with these lines in mind. None of this requires you to be wealthy or sophisticated. It simply requires knowing the lines are there before you cross one. Let me show you how the smartest retirees actually put this into action, year by year, because seeing it work makes it click. Think about the years right after you retire, but before you turn 73, when those required withdrawals begin. For a lot of people, that is a stretch of 5, 8, sometimes 10 years where their income is unusually low. The paycheck has stopped, but the big forced withdrawals have not started yet. That quiet window is pure gold, and most people waste it completely. Here is what a careful couple does instead. In each of those low-income years, they convert a modest slice of their traditional IRA into a Roth. Not so much that it shoves them over a threshold, just enough to fill up the low tax brackets they are already sitting in. They choose to pay a little tax now, at a low rate, on their own terms. And every dollar they move does two good things at once. It shrinks the traditional balance that will one day force those big required withdrawals. And it builds up their Roth, that wonderful bucket they can spend from later without adding a single dollar to their combined income. So by the time they reach 73, their required withdrawals are smaller, their taxable income is lower, and they can lean on that Roth money to stay comfortably below the lines. The torpedo that would have hammered them for the rest of their lives quietly diffused years in advance. And notice, it did not take a fortune or a fancy advisor. It took a simple plan and the willingness to pay a little tax on purpose in the right years, so you never pay a lot of it by accident later. If you are sitting in that window right now, this is the single most valuable thing you can look into. And if you are not there yet, just knowing it is coming lets you get ready. Let us bring it all together, because once you truly see this, you cannot unsee it, and that is a good thing. Here is the whole picture, in plain terms. Your Social Security can be taxed up to 85% of it, depending on a number called your combined income. The lines that decide it, 25 and 34,000 for singles, 32 and 44,000 for couples, have been frozen for decades, which is why this tax now reaches ordinary retirees it was never meant for. In the danger zone, the tax torpedo means each extra dollar of income can be punished at 40 or 50% or more because it drags your Social Security into being taxed alongside it. The everyday triggers are the normal ones. the traditional withdrawals, the required distributions, the Roth conversion, the sale of an investment. That new senior deduction helps for a few years, but it did not make the tax disappear. And your best defenses are Roth money, smart conversions in your low-income years, careful timing, and charitable distributions. So here is your one assignment. Before your next big withdrawal, sale, or conversion, pause and ask yourself one simple question. Will this drag more of my Social Security into being taxed? That single question, asked at the right moment and checked with a good tax professional, can save you thousands of dollars over your retirement. If this helped you finally understand a rule that quietly costs retirees so much, do me a favor and share it with your spouse or a friend who is on Social Security, because almost nobody warns us about this until the bill has already arrived. This is Henry Cole. Take care of yourself, take care of each other, and I will see you in the next one.